You remember that moment when Michael Burry predicted the 2008 housing crash, right? When everyone called him crazy, when his own investors demanded their money back, when the entire financial establishment dismissed him as a pessimist who didn't understand the new paradigm of housing finance. And then he was proven devastatingly correct, turning his fund into billions while banks collapsed around him. Well, he's warning us again. Right now. And just like before, the vast majority of people are ignoring him, laughing at him, calling him outdated. But here's what should terrify you. The pattern he's identifying isn't just similar to 2008. It's eerily identical to 1929, right down to the specific sequence of events, the exact same psychology driving markets, and most chilling of all, the identical dismissive attitude from those who should know better. I've spent months analyzing Burry's recent warnings alongside historical market data, and what I found keeps me awake at night. The man who saw the subprime crisis coming years before anyone else is now pointing at a pattern so obvious, so historically proven, that the fact we're ignoring it might be the clearest sign we're about to repeat one of the darkest chapters in financial history. In the next few minutes, I'm going to show you exactly what Burry sees, why the parallels to 1929 are not coincidental, and most importantly, what happens next if this pattern continues on its current trajectory. Let me take you back to September 1929, just weeks before the crash that would define a generation. The stock market had been on an unprecedented tear. The Dow Jones Industrial Average had climbed from 191 in 1928 to 381 by September 1929, a stunning 99% gain in less than 2 years. Sound familiar? It should. But here's the part that history books often gloss over. In those final weeks before the crash, a handful of investors started sounding alarms. Roger Babson, a respected financial analyst, gave a speech on September 5, 1929, warning that a crash was coming. The market dropped sharply that day in what became known as the Babson break. But then something fascinating happened. The market recovered. Investors who had briefly panicked felt foolish. The mainstream narrative shifted to mocking Babson and anyone else raising concerns. Yale economist Irving Fisher famously declared on October 17, just days before the crash, that stock prices had reached what looked like a permanently high plateau. The New York Times ran articles dismissing the pessimists. Investors piled back in, convinced that this time was different, that the American economy had entered a new era of permanent prosperity. We all know what happened next. On October 24, Black Thursday arrived. The market lost 11% of its value at the opening bell. Panic selling overwhelmed the exchanges. By October 29, Black Tuesday, the market had collapsed entirely, losing another 12% in a single day. But here's the crucial detail that connects to today. The people who saw it coming, who tried to warn others, weren't just ignored. They were actively ridiculed right up until the moment they were proven catastrophically correct. And the warning signs they identified? They're appearing again right now. I need to pause here for a moment, because I can almost feel what you're thinking right now. That sinking feeling in your stomach as you recognize these patterns in today's economy. You're not alone in this. I hear from viewers every day who say they've felt this same unease, but couldn't quite put their finger on why. Let me ask you directly, which warning sign I've mentioned so far resonates most with your personal experience? Your insight helps others in our community recognize these signals in their own lives. Drop a comment with the warning sign that concerns me most is. And share your perspective. Your comment might be exactly what someone else needs to read to finally take action before it's too late. Now let's examine what Michael Burry actually predicted in 2008 and how he did it, because understanding his methodology is crucial to understanding why his current warnings should terrify us. In 2005, when the housing market was still climbing and mortgage-backed securities were considered the safest investment on Wall Street, Burry did something that seemed insane. He started buying credit default swaps, essentially betting billions that the housing market would collapse. His investors revolted. They literally tried to pull their money out, accusing him of losing his mind. Major banks laughed at him while simultaneously selling him the swaps, thinking they were taking free money from a fool. But Burry had identified a pattern. He'd read through hundreds of mortgage packages and discovered that they were filled with loans to people who clearly couldn't afford them. Adjustable rate mortgages that would reset to payments borrowers couldn't possibly make. Stated income loans where people simply wrote down whatever income they wanted without verification. And critically, He noticed that housing prices had deviated dramatically from their historical relationship to rental prices and median incomes. The math didn't work. The fundamentals had completely disconnected from reality. And most telling of all, everyone from real estate agents to financial advisors to government officials kept insisting that housing prices could never go down, that we'd entered a new paradigm where old rules didn't apply. When Burry tried to explain his concerns, he was met with the same dismissive attitude that greeted those who warned about 1929. Until September 2008, when Lehman Brothers collapsed and the global financial system nearly imploded. Burry's fund made over $700 million, while the world economy lost trillions. Fast forward to today, and we need to look at another historical example that perfectly mirrors our current situation. In Japan during the late 1980s, stock and real estate prices soared to absurd levels driven by loose monetary policy and a belief that Japanese economic dominance was inevitable and permanent. The Nikkei stock index climbed from around 10,000 in 1985 to nearly 39,000 by December 1989. Real estate in Tokyo became so expensive that the grounds of the Imperial Palace were theoretically worth more than all the real estate in California combined. Sound ridiculous? It was. But here's the key parallel. When economists warned about the bubble, they were dismissed as pessimists who didn't understand the unique nature of the Japanese system. The phrase "this time is different" became a mantra. Structural differences in the Japanese economy supposedly meant that Western economic rules didn't apply. The Bank of Japan kept interest rates low, encouraging more speculation. And when the bubble finally burst in 1990, Japan entered what became known as the lost decades, a period of economic stagnation that continues in many ways to this day. The Nikkei still hasn't recovered to its 1989 peak, more than 35 years later. An entire generation saw their wealth evaporate and never return. And the people who saw it coming and tried to warn others? They were ignored until it was far too late to protect yourself. The pattern reveals itself clearly when you study these examples alongside current conditions. Stage 1 is always easy money. Central banks lower interest rates to stimulate the economy, making borrowing cheap and saving pointless. This pushes investors into riskier assets, searching for returns. In 1929, it was stock market speculation on margin. In 2008, it was real estate and mortgage-backed securities. In Japan, it was stocks and property. Today, it's everything from stocks to cryptocurrencies to meme stocks to SPACs. Stage 2 is the rationalization. As prices climb beyond any reasonable fundamental valuation, a narrative emerges to explain why this time is different, why old metrics don't apply, why we've entered a new paradigm. In 1929, it was the permanent prosperity of the American economy. In 2008, it was the idea that housing prices never go down and that financial engineering had eliminated risk. In Japan, it was the unique superiority of their economic model. Today, it's the belief that technology has fundamentally changed valuation metrics, that innovation justifies any price, that central banks will always prevent serious downturns. Stage 3 is the dismissal of warnings. When analysts point out the obvious disconnection between prices and underlying value, they're not just disagreed with. They're mocked, ridiculed, accused of not understanding the new reality. This stage is critical because it silences dissent and creates an echo chamber where everyone reinforces each other's conviction that prices can only go up. Stage 4 is the acceleration. As the bubble matures, price increases actually speed up. The people who were cautious early feel foolish watching others get rich. Fear of missing out becomes the dominant emotion driving investment decisions. Valuations that seemed crazy months earlier now seem conservative. Stage 5 is the crack. Something breaks. It's often something small, seemingly unrelated, that shouldn't matter. But it reveals the underlying fragility of the entire structure. In 1929, it was Babson's speech and the initial sell-off. In 2008, it was the failure of two Bear Stearns hedge funds in June 2007. In Japan, it was the Bank of Japan raising interest rates in 1989. The crack appears, markets wobble, but then they recover. This recovery is crucial because it creates one final wave of confident buying. Stage 6 is the avalanche. The system that seemed unshakable reveals itself to be built on sand. Selling accelerates. Margin calls force more selling. Asset prices collapse. Credit freezes. And suddenly everyone can see what the warnings were about, but by then it's far too late to protect yourself. Stage 7 is the aftermath. The crash isn't just a market event. It's an economic catastrophe that destroys businesses, eliminates jobs, and wipes out savings. The recovery, if it comes at all, takes years or decades. And throughout it all, there's a collective amnesia about the warnings that were given and ignored. If you're finding value in this analysis so far, take a quick second to hit that subscribe button. We're just getting to the most important part, and I want to make sure you receive our future updates as this pattern continues to unfold. So where are we right now in this sequence? Let me show you exactly what Michael Burry has been saying and why it maps so precisely onto the pattern I just described. In recent months, Burry has warned about the passive investing bubble, the concentration of capital in index funds that buy stocks regardless of valuation, creating distortions that make the entire market fragile. He's pointed out that we've reached valuation levels similar to both 1929 and 2000, with the Shiller P/E ratio, a measure of stock prices compared to earnings over 10 years, sitting above 30, a level reached only 3 times in history before major crashes. He's highlighted the explosion of government and corporate debt, noting that total debt to GDP ratios have reached levels that historically precede severe economic contractions. And most tellingly, he's warned about the everything bubble, the fact that nearly every asset class from stocks to bonds to real estate to cryptocurrencies is simultaneously overvalued, leaving nowhere to hide when the reversal comes. But here's what should make your blood run cold. The reaction to Burry's warnings is playing out exactly like 1929, exactly like 2008, exactly like Japan in 1989. Financial media dismisses him as a permabear, someone who's always predicting doom. Retail investors on social media mock him, posting screenshots of his old warnings that didn't immediately come true, as if timing being off by months somehow invalidates the fundamental analysis. Wall Street analysts explain why he's wrong, why this time really is different, why technology and innovation and central bank support mean we've entered a new era where old rules about valuation don't apply. The exact same pattern of dismissal, the exact same confident reassurance that the pessimists don't understand the new paradigm, the exact same setup for catastrophic failure. Let me give you specific current data points that map onto the pre-crash patterns from history. As of late 2024, margin debt, the amount of money borrowed to buy stocks, has reached all-time highs above $750 billion. In 1929, margin buying reached extreme levels right before the crash. In 2007, margin debt peaked at around $400 billion just before the financial crisis. We're now nearly double that level. Corporate debt has exploded to over $10 trillion, with a significant portion of investment-grade bonds sitting just one downgrade away from junk status. These are companies that borrowed heavily when rates were near zero, and now face refinancing challenges as rates have risen. In 2008, it was subprime mortgages. Today, it's potentially investment-grade corporate debt that could get downgraded en masse, triggering forced selling by funds that can only hold investment-grade bonds. The concentration of market value in a handful of mega-cap technology stocks mirrors the concentration that preceded both 1929 and 2000. Currently, the top 7 stocks in the S&P 500 represent nearly 30% of the index's total value. In 1929, a handful of popular stocks like RCA dominated market capitalization. In 2000, it was the dot-com giants. Both times, when those leading stocks finally broke, they took the entire market down with them. And perhaps most concerning, retail investor participation has reached levels not seen since the dot-com bubble. Options trading by retail investors has exploded. People with little to no investment experience are leveraging themselves heavily on the conviction that markets only go up. This always, without exception, marks the late stages of a bubble. Now let's talk about what Burry sees coming next, and why his track record means we should pay attention even if we don't want to hear it. He's specifically warned about a melt-up followed by a crash. The melt-up is stage 5 of the pattern I described earlier, where prices accelerate upward in a final surge as the last holdouts give up on caution and jump in, terrified of missing out. We may be entering that phase now, or we may have already passed through it. The crash, when it comes, won't be a gradual decline that gives you time to adjust. Based on the 1929 pattern, based on 2008, based on every major bubble in history, it will be sudden and severe. Markets that took years to climb will give back those gains in weeks or months. And here's the part that most people don't want to think about. The aftermath won't be a quick recovery. When bubbles this large burst, when debt levels are this extreme, when valuations are this disconnected from fundamentals, the economic damage is profound and lasting. In 1929, the market didn't recover to its pre-crash peak until 1954, a full 25 years later. After the 2000 dot-com crash, it took until 2013 for the Nasdaq to recover. Japan's Nikkei still hasn't recovered after 35 years. The idea that you can just hold on and wait for the market to come back assumes that the recovery will happen in your investment lifetime, and history shows that's far from guaranteed. Burry has also warned about inflation, specifically the pattern of how central banks respond to asset bubbles bursting. In 2008 and 2009, the Federal Reserve responded to the crisis by slashing interest rates to zero and starting quantitative easing, printing trillions of dollars to support the financial system. This prevented a complete collapse but also planted the seeds for today's problems. Asset prices were reinflated rather than being allowed to reset to sustainable levels. Now rates have been raised to combat inflation, but debt levels are so high that many borrowers, from homeowners to corporations to governments, can't handle higher rates for long. The Fed faces an impossible choice. Keep rates high and watch debt defaults cascade through the system, or cut rates and risk reigniting inflation. Either path leads to serious economic pain. Burry understands this trap because he's studied the historical playbook. In the 1970s, the Fed tried to fight inflation but kept backing off when the economy weakened, leading to a decade of stagflation. In the 1930s, the Fed tightened policy in 1936 and 1937, afraid of inflation, and triggered a severe recession within the Depression. Today's Fed is navigating the same impossible trade-offs, and Burry is warning that there's no good outcome from this position. The time frame is uncertain, and this is what allows the dismissive crowd to keep dismissing. Burry's warnings about the current situation have been building for over 2 years. Some mock him for being early, as if being early somehow means being wrong. But here's what the historical pattern shows. The warnings always come before the crash, sometimes years before. The people who wait for confirmation, who want to see clear evidence before taking action, find that by the time the evidence is undeniable, it's too late to protect yourself. In 1929, the warnings came throughout 1928 and early 1929. The crash came in October. In 2008, Burry started warning in 2005. The crisis came in 2008. Early doesn't mean wrong. It means prepared. And right now, we're in the window where the warnings are out there, clear and based on solid analysis, but the majority still doesn't want to listen. If you've made it this far, you already understand what most people won't until it's too late. This channel isn't about creating fear. It's about building a community of financially prepared people who see the patterns that others miss. Subscribe now and join us as we navigate these uncertain economic waters together. Each week, I break down another hidden signal that the mainstream financial media either doesn't see or won't tell you about. You don't have to face these challenging times alone. Hit subscribe, turn on notifications, and let's protect what you've worked so hard to build. Michael Burry was right before when everyone said he was wrong. He was early, not incorrect. And being early gave his investors time to position themselves for what was coming. Right now, his warnings are being dismissed again with the exact same confident mockery that preceded every major crash in history. The question you need to ask yourself is simple. Do you want to be part of the crowd that realizes too late, or part of the informed minority that saw the pattern and took action? Your financial peace of mind is worth that small action today. Subscribe, turn on those notifications, and make sure you're ahead of what's coming rather than caught in the aftermath wondering why nobody warned you, when the truth is, they did, you just had to be willing to listen.